profit mechanisms. Okay. I know sometimes people like to use reverse psychology, like I'm going to go out there and prove that I have, here's 81 of them. I'm not doing it, but I'll teach you one or two of them extra today just because I want to do it. But these mechanisms, okay, these little things, these little quirky little excuses to get into the trade with a precision element that's not linked to anything where I can say, I learned it from so and so's book or I learned it from so and so's course. It's something that's in price action. And when you observe it and you see it and you start seeing it a lot, and then you can anticipate, but it should form when it does this, and it starts doing it, and you do it for 20, 30 years, you don't need to be convinced any further of it, right? So when we look at times of day, like I said, I'm pushing Caleb into the morning session. He may elect to go when he gets good at that morning session. He has to do that first. Then he can make the decision if he wants to go to an afternoon session or if he wants to trade the London session. But I'm going to force him and twist his arm basically that he has to perform in the morning session. That's his payment for me investing my time and energy and pushing him along. He has to do it there. So it's kind of like remember the movie Kill Bill? She went to train with the master, and he was going to put her through the ropes the way he wanted her to go through it. Well, that's what I'm doing with him, okay? Because he's going about this the second time around, so he's going to have to earn it a little bit harder. So morning session is his focus, but the afternoon session has its own characteristics as well, and just as much as the London session has its own characteristics. So if you are just looking for a way to get in the marketplace or how to trade and get in, you can clearly find that on my YouTube channel. It's absolutely easy. Silver bullet, optimal trade entry. Um, it's a matter of what is it you're trying to do. And if you go into the mentorship, which is all for free on this YouTube channel, you go into the playlist, you'll see it. It's divided by month. I will teach you very specific elements about short-term trading, day trading, swing trading, the ultra short-term scalping, and they're very specific elements. But it's assuming that you have already done the work of looking at all of the broad brush concepts and modules that I have on this YouTube channel. For someone that's brand new, just stepping out and says, I'm going to watch 5 videos from ICT today, you're not going to walk away understanding it. You're not going to, all it's going to do is give you a better foundation, one more cog in it, and those pieces come together when you sit down, like I was explaining yesterday, and in the first lecture as well, when we're watching real-time price action. You're not trying to hold your feet to the flame and say, I have to know what it's going to do right now. It's not realistic for you to have that at the early stages. And you got to give yourself permission to do that and have that peace of mind knowing that keep doing what I'm showing you how to do, and it will come by default. It will be a response naturally because you'll see these things repeating over and over and over again. And what will be exciting for you is that you see them occurring at the time of the day when they should occur, which removes the whole idea that the markets are ambiguous, they're random, and they're in no way, shape, or form not rigged when they absolutely are. They really, really are. So maybe we first saw this live stream when I first tried to start it at 1:45. I noticed I couldn't hear myself, but I put the screen on so that way you could see the new day opening gap, high and low. And we're going to talk a little bit about that because Caleb, that's going to be like a lot of what you're aiming for as an underlying narrative. Okay, so while you may be aiming for an intraday, okay, or intra daily session, relative equal high or relative equal low, to draw to as an objective for your trade, it's going to be linked to a new day opening gap and or new week opening gap. And if this is the first time you've heard those terms, I will explain what they both are in this one and what you're going to be doing with them, Caleb. Okay, so we talked a little bit about how at 7 o'clock, at 8 o'clock, and at 9 o'clock, the immediate 30 minutes after that, or each one of those top of the hour intervals, we want to anticipate a opposing direction in the marketplace. So the assumption is you have already identified after 7 o'clock in the morning New York local time a relative equal high or relative equal low, or where price is smooth. Okay, and then you're anticipating, you're not arm wrestling the market, you're not forcing that it has to go there because you now see it, so therefore it can't do anything but go there. That's not what you're supposed to be doing either, which is why I taught you in the first 2 sessions together, is just to relax. and observe. You have to observe. You have to sit back and watch what does price do and record your observations. If it means taking screenshots as price is going and moving around, and it may not be near anything of any particular importance, like an order block or a fair value gap or something like that. And no, Kimmel, an inversion fair value gap is not just a fair value gap. There's two distinct things going on there, but it's okay. It'll be in the book. The idea of you using these intervals as a starting point, a delineation in time. So, okay, now I'm really focusing. It's 7 o'clock in the morning. Whatever's happened overnight during London, whatever's happened in the previous day's trading, I'm not factoring anything in yet. I want to see the design, the engineering of liquidity. And what does that mean? When price creates these really smooth areas of relative equal highs or relative equal lows after a session changeover, meaning at midnight New York local time, that is the beginning of true day. That's the beginning of the real true day in financial markets. So the algorithm likes to refer back to that time, and then everything since that time, it'll refer to for the purposes of liquidity or inefficiencies. Outside of that, you'll have things like new week opening gap and or new day opening gap, which is what you see here on the chart. New day opening gap. What that is, and let me just maximize this chart. Well, actually, let me do it on a 1-minute chart because it'll be a little bit easier for you to see it. Every day, except for Friday, this is for specifically the index markets. Okay, so while I'm teaching my son how to trade and make money in that asset class, this is not something to lose your mind over. It's really simple. At 5 p.m., again, every day except for Friday, the market closes at 5 p.m. It stops and it pauses for an hour, and then it resumes at 6 p.m. Eastern Standard Time. If you take your 1-minute chart, you don't have to have live data to do this. It's something that is a long-term effect on price action. It'll be used for weeks, okay? And I'll explain it in a second. Here is the 459 candle on a 1-minute chart. My candles that are bullish are green, and my candles that are black are bearish. So the up close candle, that is the closing price where we stopped, and it's the last print for NASDAQ on Tuesday going into the 5 o'clock stop. And then at 6 o'clock, all you do is simply get in front of your computer, wait a couple minutes right before 6 o'clock, and wait for the first print on a 1-minute chart. When it opens up, that opening price, you drop a line segment on it, okay? And what I do is, all I do is I take this little line thing here, a horizontal ray, and I just go and I drop it on the opening price. And you can annotate it any way you want, okay? I know some of you folks that are on the other side of the pond, if you will, you don't like to see our numerical version of, like, today's date for me would be 08/07/24. And for you across the pond, you would probably see that as July 8th. And obviously it causes confusion. So I generally don't annotate it like this, but for the purposes of not confusing anyone and for completeness sake, when you highlight and annotate your chart, you have to do this. Okay, this is the part. If you just put these lines on your chart, and you're going to have about 5 of them, because you're going to use the present week, or if it's on the weekend, the new one that forms on Sunday's opening price. You annotate that on your chart, and then you'll have 4 more prior to that. So you're always going to have like a floating reserve on your charts of 5 weeks of new week and new day. I'm sorry, for new week opening gaps. 5 days look back for new day opening gaps. New week opening gaps is 5 weeks. So when we have these levels annotated like this, you can call it whatever you want. You can label it the way you want. But I taught my students that this would be referred to as the new day opening gap high. Now, why is that? It's the new day opening gap high because at 7 o'clock in the morning on Wednesday, and yes, that gap forms technically on Tuesday evening, my local time in the east coast of the of North America. But that's really technically a gap or inefficiency that is attributed to and should be used for the basis of Wednesday's trading. So it's a little confusing, but if you rewind that and listen to it again, it's pretty straightforward. But at 7 o'clock in the morning, there's 7 a.m. And if we scrub this down here, you can see that we are way above that new day opening gap. See that? And since this is the first level you would come to, that makes it what? The new day opening gap high. And then the next level below it, which would be whichever is the next reference point. You can have a gap. In this case, we have a gap that has gap down. So where we closed here on this candlestick there on Tuesday at 5 o'clock, we open lower. You see that? Now, when we drop down to it here, what we have done is we left this portion between this candle's low or whatever this one is, whichever's lower, that little segment of inefficiency is still present because what is it lacking? What's it missing? Sell side delivery, not sell side liquidity, sell side delivery. Okay, so if you look at this candlestick here, we opened and traded up. So there's nothing passing down into that candle's low, or I'm sorry, the opening price. It's not offered yet. So when we annotate our chart like that, these gaps, okay, these gaps will be referred to for a week. Now sometimes you'll see they actually get referred to a couple weeks later. Still, they'll be sensitive because they're real algorithmic arrays where the market will refer back to them. But I'm not going to be able to teach you every aspect about those things because to do that opens a Pandora's box for me and I'm not going to do it. Okay. The fact that these exist and once they get traded to, anybody else that looks at gaps would think, okay, it filled the gap and that's it. Throw it out the window. It's done. It's over. Kind of like how the myopic view of supply and demand where they say, I need a fresh zone. Everything I serve up as a PV array is piping hot and fresh every single time. It doesn't get stale. Okay, but for the rule-based idea trader in you, new day opening gap, this is the part where you write down your journal, folks, or your notes. New day opening gaps have a life cycle of 5 days. Okay, you can use them longer if you want to, but for the teaching purposes, when I taught new day opening gap first, I taught it on Twitter. I introduced it there in Twitter Spaces, and I talked about it as a after fact and made its way into my lectures on the YouTube channel. They can act like magnets where it draws price back down to them because these levels, these gaps, have real value in them because there's an absence of any real trading. Even when you see them open up initially here, we can see that it opened there, it traded above the previous day's close, does so here, and comes back down, and then runs back up, stays around in here, runs back up, stays around here, drops, consolidates, drops a little bit, and leaves a small portion. If you take a Fibonacci, okay, if you take a fib and you drop it on the lowest open or close, if we, let me say this part first before I get any further. If you look at it from here, I'm going to zoom in, use this little thingamajig here. Zoom in real tight. Here's the closing price on the Tuesday at 5 o'clock. We opened down here, so that's a lower gap opening. The opposite would be this, where we opened above that closing price. So if we opened up here, then you would draw the same lines the same way, and you're using this ray down here. That extends it in perpetuity. It keeps going to the right. It never stops projecting it to the right. And your annotations, when you annotate them, put it on the middle and to the right, and then you label it. Real important that you put the date in it. Whatever format you want to use, it's up to you. But that format, or that date rather, helps you organize the level of importance. So what does that mean? If you have a new day opening gap, say for, I don't know, 2 months old, okay? 2 months old, and we haven't referred back to it since the day that it formed. And then in that instance, I would find it important. I have a journal page, a spiral notebook basically, and I write down every single new day opening gap, high and low, and its midpoint or consequent encroachment. And I'll explain what that is in a second too. And I keep a running log of that. And as long as we're 150 handles in close proximity to any one of them, then I personally will look at them. So I'm kind of like showing you my hand a little bit today. So for you, because it's something probably new to you, and you're probably going to have a whole lot of them on your chart because you're going to think that you have to have every single one of them forever. It's until it, you know, until you run away from all the ones that you're presently trading around. Um, you don't want to clutter your chart up, but I like to see them. And in my journal, it has a spiral, page that it's basically a column, and I write down what that market is, and it's usually just the S&P and the Nasdaq, and sometimes the bond market. The the high and the low and the consequent encroachment and the week that it opened up and formed. So, for instance, this is for Tuesday, okay, on the day it formed. But is it for Tuesday's reference? No, it's for Wednesday's trading, and that's why it's labeled that way. Okay, so you're going to use the next day after the 6 p.m. candlestick. So if you look down at the bottom of the chart down here, it says Tuesday, August 6th. But really what we're doing is we're building a reference point for Wednesday's trading and for the next 5 days. So that means this will overlap into next week. 5 trading days, not 5 calendar days, 5 trading days. Okay. If you have a holiday, skip that and add one more day to it. And that's kind of like your life cycle for new day opening gaps. New week opening gaps go back with a life cycle of 5 weeks. So you're always going to have 5 weeks of new week opening gap. And a new week opening gap is where we stop trading on Friday at 5 o'clock, and then where we open up at on the Sunday at 6 p.m. And then you mark it the same way here. The only difference is you would say NWOG, which is new week opening gap. They tend to be very sensitive still 5 weeks back. Now, that's not it's ended at 5 weeks and you can never refer to them again, okay? It's just a general rule or principle that you can start with. You're going to discover that they work 6 months, 9 months still away because they are actual places where the market didn't really efficiently trade, as I'm showing you here. But if you take the levels, once you have them on your chart, you want to, on TradingView, you want to create a, I don't know what they call that. Let me do this real quick. Whatever this is called up here, layouts, okay? You want to create a layout that has a title that maybe it's new week opening gaps. And on that layout, the only thing you have referenced for the market that you trade or markets are simply just the new week opening gaps. And or you create a layout that has the only new day opening gaps or new week opening gaps rather that is salient to your market. So that way, if you're ever watching price action, or if you start your new trading session today or tomorrow or tonight, whatever you trade, when you pop up one of your layouts, you'll have the information right away populated on your chart. And you don't have to have all that stuff on your chart when you're working with the chart time frame that you're exercising or executing on. So I'm saying that for the folks that are working, because I'm physically sitting down with you with a laptop. So I don't have all the multiple charts or screens in front. I mean, they're in front of me, but they're off. But I'm trying to teach it from a perspective of using a single device like one laptop. So that way it helps you manage your information and not clutter your chart all up. But once you have them on, this is how you get the other levels that are important to me. You use the low, drag it up to the close, which is the high or new day opening gap. And here is your consequent encroachment. That's the midpoint, okay? That's not equilibrium. It's consequent encroachment. Why is it consequent encroachment and not equilibrium? because equilibrium is a range that has been delivered up and down. Okay, think of it like a trading range. This is not a trading range, it's a gap. It's a real gap. So that real gap has a missing level of buying and selling. There's really no buying and selling yet because we stopped trading on the previous session at 5 o'clock and then resumed trading here. So there's nothing being offered as a buy or sell, no printed trades until that opening right there. And then it starts trading. But what is it doing? It's delivering buy side delivery. That means it's going up. So what is it lacking? Sell side delivery. If we take this level here and we add 75 and 25, 0.25, 0.75. What that does, it grades into equal quarters the range. Okay, watch what happens. Look how it stops perfectly right there. What's that price? 18,049.50. It stops exactly right there. Right there. Look at that candles. Look at that candle's low right there. Right up here. Look at that price right there. Okay. What's the low of that candle? Folks, that's fucking perfect. Okay. Perfect. You can't improve on that. You're going to tell me buying and selling pressure stop that right there? Some random bunch of jokers out there looking at goofy stuff. They stop the market right there? Okay. Look how price gravitates around the upper quadrant. See that? See how it's gravitating around that? And then it expands just a little bit. Let me take this off because you're probably thinking this has something to do with it doesn't have anything to do with this. Let me take this off. These are extensions for like swing targets and stuff. So the last time we talked, I was showing you yesterday's live session. That's why that was on there. And if you don't believe me, go back and look at the recording and you'll see those levels were actually the ones that were highlighted in my fib. So here we have the upper quadrant, midpoint or consequent encroachment. Consequent encroachment is the midpoint of any gap or any inefficiency. Okay, that means if it's a SIBI, that means it's a down close fair value gap. The midpoint is consequent encroachment. The best shorts will form at the lower half of that because you want to see the upper half left open. A midpoint of a BISI, which is an up close fair value gap, the best fills for going long are going to form in the upper half of that. You want to leave the lower half open. Why? Because you want to see it create a breakaway gap. That inability to fill in that area down there, and if it rallies, that indicates to you that the algorithm is really going to start spooling quickly and you anticipate large range expansions. Holy shit, I'm dropping some diamonds today, aren't I? Yes, I am. Because it's 2024, baby, and it's about time for you to start making some fucking money around here. So this lower quadrant, beautiful. Consolidating. It trades just outside of the new day opening gap. And the market trades down. Look at the sensitivity on the upper quadrant. You see that? See it? Look at that. It's staying very, very close to the upper quadrant. And then boom, we trade down to consequent encroachment. And then one more time, look where it trades. That lower quadrant. Does it one more time just to take the low out, but does it come down and touch the very, very low of the new day opening gap formed at Tuesday, 6 p.m.? No. So what's it doing now? It starts to rally higher. We have this little segment of price action here that is inefficient. There's no trading down there. Once it formed this low, it starts moving higher. If you have these levels on your chart, even if this was to come down and touch that low here and then moved out of it, that does not make this high, that midpoint, or that low stale or of no consequence or importance anymore. It's still meaningful to me for 5 days, 5 trading days. Okay, so if this is for Wednesday, this is for your notes. Make sure you write this stuff down now. Since this formed on Tuesday for Wednesday's trading, you have Wednesday's trading, so that's day 1. Thursday's trading, that's day 2. Friday's day 3. Monday is trading for day 4. and then Tuesday. So this new day opening gap is still valid until Wednesday next week. That's how I would classify it. Okay, so that way, if you have any confusion about how long they're useful to me, or not that they're not useful, but I love the sensitivity around them for the next 5 days. Let's say it that way. I think it's a better way of representing what I really mean. But in truth be told, I will use them 9 months in the past if it's within the narrative I'm expecting to see price behave around them. And that part is experience. So just know that what I'm showing you here is gold, and I'm going to show you how to use it a little bit more specifically because it's my son that's actually the audience member I'm aiming for. So we can see how the market leaves that area. Yeah, there's no algorithm. Here's 7 o'clock, here's 8 o'clock, here's 9 o'clock, and we were way above it. We're really north of it when it formed those opening intervals. So 7, 8, 9. I must have moved that line. I apologize. I was looking at those lines and they're like, they don't look uniform. Yeah, so here's 7, 8, and 9. And we were way above it. So here we are. Oh, there you go. While I was talking the jawbone, it went down and closed it in. Okay. So if you watched it at the very beginning, the recording's still there. I'm going to delete the recording of the first attempt to try to do the live stream. So you'll see this. It was actually in the chart beforehand. But it's not a big deal. I mean, most of my students already know about new day opening gaps anyway. But the ability to want to see it gravitate back to them every single day, if you have the last 5, like the week you're trading in right now, that's 1 week of it, or 1 day of it rather, and then you go back the last 4 trading days. So you have 5 of them on your chart, and as long as we're in close proximity to them, they're going to be impactful to your trading. And if you're bullish, if there's one above you, but there's several of them below you, now this right here, folks, this is gold dust. Okay, if you have a clustering of new day opening gaps, predominantly above where the market's trading at, and maybe there's one where you're trading at now around the market, or maybe it's below you, where do you think the market's more likely to go? Oh my goodness. Oh my goodness, I'm getting moist. It's going to gravitate where the multitude of inefficiencies existed, because it's going to give the market an opportunity to go back there again. Why? Because there are people in this industry that trade with this information that you're not supposed to have. And it provides that vehicle of entry, that mechanism of repricing up there. It has absolutely nothing to do with buying and selling pressure. As much as those little goobers that write those books and sell courses tell you, it's not how it works, folks. That's not how it works. And if it breaks your heart, God bless you, get over it, because this is what really makes the markets move around, time and price. But you have to have reference points to know, how do these markets book price? Because they're going to use these hidden areas. Oh, they're not hidden, ICT. Everybody knows about gaps, right? And look at everybody else's use of them. It's going to be a gap fill, and then it doesn't fill the gap. It runs away. And then the gap's used later on at some other time. And once it fills, they're not always interested in it anymore. A la Chris Laurie. He'll say there's an inefficiency, a buy-side imbalance, as we call it, buy-side imbalance, sell-side inefficiency. He'll call that a liquidity void. That's not a void of liquidity. It offered buy-side delivery. There was buyers going on in there. What's absent? Sell-side delivery. That means moving right back over top of it and tamping over top of that run up in that single candle. So you can look at it. Look at his stuff. Okay, he would say, okay, we're done now. We're done with that. Once it filled it in, he's done. Next setup. Not me, brother. Not me. These things around specific times, they are absolutely useful and will be used by the algorithm. Now think about it. If everybody has the same logic that once a gap fills, it's over, then why would they fucking work again over and over and over again every time you trade back to them? And nobody's ever noticed it? No one's ever noticed it. I got over 2,000 trading books, okay? Not one of these jokers ever talked about it, ever. And the first time I started using this information to call the market in front of family members and friends and say, watch what it's doing right here. Look what it's going to do right here. I don't have the levels drawn on it. I'm just telling them this is where it's going to go. So in other words, I'd have the level here, here, and here just in my mind. Say, okay, I know that number. That's the one I'm going to see it trade to. And to watch their jaw open up, like, how do you know that? Yeah, it's good, isn't it? Isn't it good? It's so good. Well, these things are always there. They're never going to hide it from you, folks. Okay? And you're probably thinking, oh, they're going to change it because you taught it. Bullshit. How are they going to change the gap? First of all, they're not going to be able to hide the gap from you. If we open at 6 o'clock higher than where we closed at 5 o'clock, we have a gap opening. It's a higher gap. Okay. I don't care. I don't care if it's an up gap or a down gap. I want to know what those levels are. What are they? The three levels here. Consequent encroachment, which is the midpoint, the highest high and the lowest low. What's the high? Whichever is higher, where we stopped at 5 o'clock or where we opened at 6 o'clock. It's a very simple process. It's not complicated. What's going to be complicated is if you're trying to have 1,000 of these things, because it's 200 some trading days in a year, you're going to have a lot of them on your chart. And you're going to look at this and say, what the hell am I supposed to do? And the jokers that are in the listening audience are going to say, well, of course it's going to hit one of these levels. There's so many of them. You're a fucking clown. This logic is very specific. Just look at the last 5. And if there is a clustering, if there's like out of the last 5, say there's 3 of them that are above price at the market price right now. When you are looking at 7 o'clock and 8 o'clock and 9 o'clock, anticipating that engineering of liquidity. I'll come into that. I didn't forget. But if you know that you have a series of new day opening gaps above, chances are they're going to want to gravitate to that. So what would that do for you as a trader? If you're anticipating a short, give it a chance in that first 30 minutes to try to reach in that direction, because they might spike it up there in a really thin price run to get up into those old new day opening gaps. Then wait for it to break down and show a market structure or a breaker, okay, or look for an inversion fair value gap, like I tell you in the part 2 of this mentorship, how to see them. Those are so powerful. They are so powerful. That is one of the bangers as a PD array. If you can sit patiently, I say this about all my PD arrays in case you don't know that, but if you could sit patiently and wait for them to form, they will give you runners that just are so good. It's like the first kiss of a girlfriend. The taste of those lips. That's exactly what it's like. It's beautiful. It's love. It's love. Love in a candlestick, baby. And this type of stuff repeats over and over and over again. So when I spent time teaching, what I have made a real attempt to do is key your mind up and your attention to these critical times and conditions where the market is more predisposed to behave a manner that's one-sided. That's what you need as a trader. You need movement, number one. You need to be able to predict that movement, and you need to be able to predict the movement's direction. Unless you're trading options, and there's a way to do that too. And you don't need to know the direction. You can be delta neutral, but that's another time for another subject matter. But in this case, we can see that these things tend to repeat. They tend to repeat every single day, every single week. Okay. So now, what's the difference between a new week opening gap and a new day opening gap? Well, there's 5 new day opening gaps in the course of a week. You only have 1 new week opening gap. So what do you think has more impact on a swing trade? A new day opening gap or a new week opening gap? A new week opening gap, because you're factoring the imbalance and inefficiency of a new week opening on Sunday at 6 p.m., where they've had a whole weekend to digest everything, and they use that opening price. Who's that? Those individuals that are in control of the marketplace. I know you don't like to hear that, and I know it pisses you off because I talk in a very condescending tone and arrogant, pricky, and all that other bullshit. But if you took the time to investigate in things that I'm telling you, you'll see that it's there. This isn't retail buying and selling pressure. It's not large funds buying and selling pressure that's causing them to turn, because that's not what happens. Doesn't matter. How much buying and selling pressure has absolutely no bearing on it. You'll be able to sit down and predict with a high degree of precision and accuracy where the market's going to gravitate to. That's the very first stage in your development. That is not profitable trading. That is not precision entries. That's not tight stop losses and low risk management. It is the first stage. And you have to warm up to that idea of knowing, okay, this guy's talking to me. He does talk a lot, but the shit he's saying and the stuff he's pointing out is happening all the time. So it's worth me listening to, because I'm not talking for the sake of talking. I'm telling you all the things that's going to arise in your mind as a fear, as a uncertainty, as a doubt. These are all things I have experienced myself, and I have millions of students. And they all give me feedback, whether I give a response back to them or not. I take that feedback and I say, okay, I can use this information, and the next time I talk about it, I'll kind of draw that into the conversation. So I know pretty much what questions you have in mind. That's why it feels like I'm reading your mind when I'm talking about certain things. So if I'm watching price action and I'm saying I'm looking for this or that, and then I'll say, and you probably think this, because I have heard all those questions before. That's all it is. I'm not clairvoyant. I don't believe in ESP. So as much as it looks like sometimes I have it, if we have a clustering of new week opening gaps below the marketplace, okay, I'm going to elect to see price try to gravitate to that. That's not a hard and fast, only going short. It just means that if I'm going to look for a long, I'm going to wait and see right away, do they want to drop it down there in that direction? It doesn't mean they have to trade to those group of new week opening gaps or new day opening gaps. Either or. It's a filter that my mentorship students don't even know anything about. They're grinning right now because they're learning just like you are. And when you have these things recorded in a layout for your chart, you'll be able to see, oh yeah, there's a number of new day opening gaps and a couple new week opening gaps that are below price. And if you've seen, we've only worked it one time. In other words, like we've seen it here, it went down into this one. This is the first time we passed down into it. And this is the second time we passed down into it. Okay. If we've only touched the new week opening gap or a series of new day opening gaps once, they're really sensitive, like they're hot. They're going to be they're going to see price draw back to them. That's just a guarantee it's going to happen. And there's very few guarantees in price. There's very, very few guarantees in trading. But this is something that you're going to study, and you're going to see what I just said is the gospel. It absolutely is always there. And that right there cancels out the whole idea that these markets aren't rigged, because why would it care? Why would it care about a gap that filled weeks ago? Why would it do that? Unless it's being called as a reference point through coding, and it's referring back to a certain span of time. Almost slipped. Let me slow down. It's a very specific reference of time that the algorithm will seek and look back to. Okay. And by having that look back period and looking at these reference points in price, so you have time and then price. And when you can identify these things, and they're never going to be able to hide where they opened the price up in relationship and in deference to where we closed it at 5 o'clock. Can you understand that much? If you're brand new and you're thinking, okay, this is probably going to stop working because it's being taught. I taught this, and it still works beautifully. It's not going to stop working. Okay, believe me, if I believed any of this stuff was going to stop working, if I taught any of it, you would never know about it. Okay, the things that I teach, they're just very market generic. They're going to behave this way all the time because this is the source code. This is exactly what it's going to do. It's always going to do these things until they tear the markets down entirely. This is what's going to be there. So as long as we can trade markets, these advantages are going to be available to you. And that should excite you. It should give you passion and desire to spend more time seeking them and understanding the characteristics around them. And what this does, it gives you a magnetized reference point of where bias can draw to, even before relative equal highs or lows form. Wait a minute, slow this down. Slow your roll, ICT. Say that one more time, because I think I just heard you say you can predict relative equal highs and lows before they form. Yeah, you're fucking right. Yep, that's exactly what engineering liquidity is. That's exactly what it is. Okay, so if you have a predisposed um, likelihood, if it's likely that we're going to draw down to a new day opening gap, or we're going to draw down to a cluster of new day opening gaps that haven't been traded to or used much, or a new week opening gaps that are clustering below market price. At what time? At what time, ICT? At 7, 8, or 9. You're referencing. You're trying to get a feel for what is it likely to do. Sure, there's going to be volatility. Sure, there's going to be probably all kinds of movement around. But what was the market showing us right away? Well, it's got relative equal highs, but it's also got relative equal lows from 7 o'clock and 8 o'clock. Okay, so if we know the new day opening gap is down here south of all that, down here, we know that it's probably going to run these highs. So you as a trader, Caleb, you're going to be thinking, all right, I know that this is a gravitational pull on price. The algorithm is going to want to revisit this, okay? If I notice that there's relative equal highs after 7 o'clock, that was the rules I gave you. There's no guidance from ICT, by the way. There's no guidance. There's no rule-based idea. He never tells you how to do it. It's just he talks vaguely, and he reinvents things and renames stuff that other people wrote about. Here's the high and the second one, okay? And the market drops down. Do you chase that? No. Why? Because you have a new day opening gap down here that it's most likely going to trade to, okay? It doesn't need the trade there today, as I'm going to prove to you in a little bit, okay? You can be profitable without it never reaching that. It could do that, return back into it here in London, like tonight. It could trade there in London tonight if it hadn't dropped down there. And that's what I would have done looking for a trade in London, okay? I know some of you are thinking, oh, here, I would have, could have. Trust me, you're about to see an execution. Just sit your ass down. These highs here, that would be an ideal scenario to run those highs out. That would be a fake move. So that would be a Judas swing, okay, as we referred to before. If we have a predisposed direction in mind where we want to trade, where there's a larger draw or gravitational pull on price that's outside the parameters of just relative equal highs or relative equal lows, because that's just one piece of it. That's just a piece of it. So you want to have a tool, a weapon, okay? A weapon in your arsenal that will help you understand with more probability, more odds in your favor, that the market's going to gravitate to a very specific range in price action. And that range needs to be a new day opening gap or a new week opening gap, Caleb. That's your black hole, if you will. It's going to draw price to it. It doesn't mean it's going to be a straight line to it. It just means that it's going to have an overwhelming impact on the overall direction of what price is going to do. There may be static price action moving around. It might have a little bit of flurry of rallies here and there, but ultimately it's going to bend a knee and go right to where it needs to go, which is the new day opening gap or new week opening gap. Okay? So this is engineering liquidity. As the market drops down, we would never go short right away after seeing new start of a new AM session at 7 o'clock and they have relative equal highs, especially if we're thinking a new day opening gap is a draw. So what we would rather do is we would rather see it trade up and cancel out this liquidity. So as it's dropping, traders are going to chase that. Think, yeah, this is really good. This is easy. All I got to do is follow the moving averages. Okay, do your stochastics overbought and oversold. You take your profit and wait for another overbought and go short, right? Well, this level you would have on your chart, and you would observe that. Okay. Above this high is buy side, okay, buy side liquidity or buy stops. The market rallies after 9 o'clock We get this little squiggly line here, and then it runs, pumps up above it. 1, 2, 3, relative equal high, then breaks down, and then creates another relative equal high. Are we more likely to clear these highs here if we have what I've been teaching you here? The larger draw, the more influential draw on liquidity are new day opening gaps and new week opening gaps. That's the real hidden, that's the magnet on price, okay? And when you start mapping them out on your chart and keeping them active on your chart with the time reference points that I've told you, like the life cycle of them, for the sake of having more time used with them, you can create an additional layout on TradingView where you keep them for as long as you want, okay? But just understand, knowing how to use them and managing them when they're older, just you have to keep track of how many times they've been referred to. And it takes a little bit of effort. And most people don't want to listen to me teach something that's going to make them millions of dollars if they put their asses to work with it. But hey, everybody wants to do their own thing. You can see the power of using this information once you start logging them in your own charts. You're going to see them in your charts once you have them. You're going to watch price do all kinds of silly shit that people on YouTube, on Twitter, on social media, if they're making their opinions vocal in public, you're going to start smiling. The corners of your mouth are going to start aching because you're going to be smiling, grinning your ass off because you can see them falling victim. They're literally falling on the sword of the market. And then they're going to get sucked into emotion going right down to these levels or up to these levels in deference to when it's bullish. But you're going to see it and you're going to watch it unfold. And you're going to have a perception over price that you've never imagined before. It literally is, if you remember watching Batman when he linked all everybody's cell phones together and it was like a radar. He could see things because of their cell phones all being linked together. Or like the Matrix, when Neo finally saw the Matrix for what it was and he could just see it in binary code, zeros and ones. And it's very, very close to that feeling, if I can use an analogy that's artistic, if you will. Because you have a vision that's outside the candlesticks. You don't see the candlesticks anymore for just open, high, low, and close. You're seeing them as a black hole, pulling price, okay? Pulling price, dark pool, pulling price. Where everybody else is unaware. They're unaware. They have no idea what the fuck's going on. They're freaking out because they're losing their trade. They're blowing their accounts. Their system stuff ain't working. The guy they're following signals are shit. They have no idea what's going on, but it's careening towards this hidden area that nobody seems to give a shit about. But they saw it when it gapped open at the beginning of the day. They saw it gap open on Sunday. Everybody knows about that gap. It's always been talked about. Gaps. Oh, everybody knows about a gap. Nobody knows about a gap, but they all know about it now. These areas of price will never, ever, 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 ever be hidden from you. So therefore, they will always have effectiveness in your trading. There'll always be efficient compartments to a trading model that has a huge impact on what makes you successful in reading price. Therefore, as a default, if you can do entries that are very systematic, that have sound logic behind them, and you have small risk and you don't overtrade, then by default, what does that mean? That you're offered and afforded potential profitability. And what happens if you do these things, these routines, these protocols, these step by step by step by step things, this guidance, and you don't deviate from it? You don't try to reinvent the wheel. Yeah, I like ICT's rims, but I'm going to spray paint them my color and call it my thing. No, don't change it. Stick to the things that I'm showing you. Don't embellish upon them. Just take that information and use it and be thankful that you got it. Because I didn't have to give it to you. I didn't have to teach this stuff to you. I've been sitting on this stuff for 3 decades, man. watching everybody else out there act like they know what they're talking about. Everybody on CNBC, the market's going to do this, the market's going to do that. Oh, shit. And then what you'll see is when you can watch social media as a herd, when they start talking about when they're bullish or when they're bearish, or they say, oh, it's a crash, the market's crashing. You'll be able to walk right in there and say, okay, I'm going to be a buyer. Oh, the market's going to drop. It's going to crash. It's going to crash. You go in there because you see that herd mentality going against an idea based on these principles. And if it's diametrically opposed, the odds, my experience, the odds are going to be in your favor and less in theirs. And that's the key to trading with high degree of precision. You have smart money, precision, and odds in your favor when you're waiting for periods of time when the market's participants that are stupid, dumb street money, that's people that talk about their ideas online. Those individuals that openly show their hand and show their cards, that is street money. Okay? Street money is my wife when Bitcoin was just about to get to 20,000 the first time, but failed. And she said, do you trade Bitcoin? I said, what did you just say to me? I said, do you trade Bitcoin? And I was like, that's it. Didn't even answer. I went right on Twitter. I said, that's it. Bitcoin ain't hitting 20,000. It's going to go. It's going to drop to 6,000. And it did. And I said I was going to go to 3,000, but I was off by 300 points. It's all history. It's all there. Her perspective is street money. It's the dumb money perspective because she doesn't know how to trade. She doesn't know how the markets operate. And here she is, she has an interest in Bitcoin because it had been going up. Everybody's talking about it. Well, there you go. You're near the high. So what I like to do, and a lot of people get pissed off at me. A lot of people that are taking my stuff and trying to run mentorships and stuff, they're really going to heat up and start talking about me. Okay, they're going to say I'm a fraud. They're going to say this, that, and other thing because they need their marketing to focus the attention on themselves, and they look like a hero because now they can point the finger back. ICT, ICT he doesn't teach you. Look at everybody's making money off the stuff I've taught. Don't forget that. Don't forget these people talking to you have made money off of the stuff I've taught. They all have a little sales pitch, and that's fine. Look, I got no problem. I got no personal beef with anybody. You're going to do what you're going to do because you need to eat, and I'm not trying to starve anybody. I'm not trying to starve anybody because what's about to happen, it's going to affect every single one of us. So if this helps me from doling out money to my son because he can now make his money doing this outside and above his job, guess what that helps me do? It helps me sleep at night. It takes any worry about him not being able to make it if something happens to me. He's able to do this. He can take care of it. And that means that his brothers who don't trade, they can learn from him. I've been trying to get one of them to do it really well. So that way I know if I have to lay my head down for the last time and leave this world, that I know I'm able to have this passed on. That's my motivation. But you have to think about, okay, well, here's relative equal highs. So they're going to run above that, right? Because ICT said they're going to run above the highs. You see what I'm showing you here today? This is underlying narrative. And you're coupling it with the engineering of liquidity. If there's an arm wrestling match, okay? Say you have an arm wrestling match between, oh, good gracious, I can't even think of anybody that's a strong man. I don't know. Just think of someone that's very, very strong, okay? Big biceps, big upper body, big latissimus dorsi, deltoids, real big. And then you have somebody, some teenager right out of school, okay, and he's got like spaghetti arms, and they're gonna have an arm wrestling match. Who's gonna win? Clearly, right? Clearly, it's gonna be the behemoth. It's a monster, right? Clearly outweighing in strength and everything. When you place the effects of what street money will see in price versus what a smart money perspective is over price, you literally are arm wrestling the strongest man in the world, expecting to win. It's not going to happen. And this repeats every single week and every single trading day because the retail crowd, number one, they don't even believe, most of you listening to me, you probably don't really believe there's an algorithm, but you entertain me because you think this is something like a nervous tick I got to keep talking about or whatever. At this point, if you don't see it or believe it, there's no hope for you. There's literally no hope for you in that regard. You don't need to believe in an algorithm for it to be profitable. You could say, well, I'm going to suspend my belief about it, and it's not important to me. I just want to trade something that works. Okay, wonderful. But you can't knock me for telling you what's really going on, because I'm not lying to you about it. It's really there. And these are the reasons why it repeats. Because if it's an algorithm, the algorithm does the same things all the time because it's following a code. It's following the syntax and coding and the logic that was used to create it. And it has to refer back to old information. It can't pull stuff out of its ass. It's not a real thing. So it has to use instructions like a recipe. Okay, if you have a recipe card, you pull it out. You say, okay, I want to make chicken Alfredo. All right, what ingredients do I need? I need this, 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 this. So the recipe is calling your attention to, well, before we begin, you have to have a measuring cup of this much Parmesan cheese and this much of this and cream and whatnot. You have to have all these information laid out in front of you, how much we have to have. But then you have to do what? You have to execute on that and get those ingredients measured out, and then you combine them. Well, the algorithm has to have that information to cull from. It needs to go back in time where it has delivered price before, and it's based on date, day of week, month of the year, week of the month, what quarter of the year, and what price and what time it was trading there. That's the real fucking nitty gritty, baby. That's what's going on. It's going back to those reference points. It is absolutely has nothing to do with how many times a level was traded to and now it's created resistance.